Welcome to MacroHive Conversations with Bilal Hafiz. We aim to bring you the best in macro and market thinking. To see our latest thoughts and analysis on the world, visit macrohive.com. We're happy to announce that SGX is the proud sponsor of this podcast episode. SGX is the largest Asian FX exchange with the deepest liquidity and the most diverse listing of Asian FX futures, including the offshore Chinese yuan, CNH, and the Indian rupee, INR. SGX FX contracts can be traded close to 24 hours, and SGX is the venue for price discovery and risk management. To find out more, please visit www.sgx.com. Before I talk about today's guest, I wanted to flag some of the great pieces we've put out this week. China, of course, has been the big focus with its explosive stock market moves, so much of our content was geared towards Asia this week. We published an outlook on Asian FX currencies, a piece on Indonesia's QE adventure, and we've released a primer on iron ore markets. And of course, iron is heavily tied to the Chinese economy. Outside of Asia, we published pieces on trends in US labor market, on how equities trade in different VIX regimes, what would happen to markets if we get a vaccine, and whether fintech is in crisis after the Wirecard scandal. It's great content on the site, so make sure to subscribe at macrohive.com. It's the cost of a few weekly English breakfast teas from reopened cafes. And with that, you get access to all of our exclusives, our summaries of academic papers, our curations of blogs and podcasts, our Slack channel, and much, much more. On to this week's podcast guest, I have Raghuram Rajan. He's Professor of Finance at Chicago Booth. He was the 23rd Governor of the Reserve Bank of India between September 2013 and September 2016. Between 2003 and 2006, Dr. Rajan was the Chief Economist and Director of Research at the IMF. He's also the author of many books, including the recent The Third Pillar, How the State and Markets Are Leaving Communities Behind. I could go on, but I'm sure you get the picture. He is one of the leading thinkers on economics today. So, on to our conversation. Welcome, Raghu, to our podcast, and thank you for making yourself available to this interview. I guess there's a lot going on in the world at the moment. Obviously, the biggest thing facing most economies around the world is how to deal with the impact of the lockdown associated with COVID and, of course, the health crisis around COVID. We've seen the initial response to the crisis, which was extreme monetary accommodation, various sort of fiscal programs to support population and so on. But now we've had a few months on from this. What would your advice be to emerging market countries, but also developed countries on the next stage of policies that they should implement to ensure that economies and populations get back on track?
As with any economic prescriptions, it obviously depends on where you are in fighting the virus. And the initial view, as you know, was that we would take a couple of months off economic activity while we combated the virus. And in the meantime, preserve businesses, preserve households as is. And then, as with Sleeping Beauty's castle, we'd wake everybody up after the 2 months and they'd all spring out of bed hale and hearty and the economy would resume. Now, that was predicated on controlling the virus and effectively arresting it and then implementing testing, tracking, and isolation measures if there were fresh breakouts, but generally getting the economy back on track after those 2 months. In some countries, it has played out largely this way with a few blips, Australia, New Zealand, China, of course, Taiwan. But even there are two, I think, remaining problems in getting activity back. One, of course, is that what you see is in these countries, demand is not back simply because people are worried about catching it from someone, especially elderly people. So yes, young people are back on the streets, but high contact services is not back, even in a place like China with all the testing that they're doing. And the second is global demand, because there are large parts of the world, prominently the United States, which is out of action. That's not back. So in effect, even in the countries that have arrested the virus, demand is likely to be weak for the foreseeable future. Lots of companies in the virus-affected industries, namely high contact services, are going to be in serious difficulty. Many are going to close. And of course, the countries that haven't arrested the virus, which is most prominently the United States, but also Brazil, India, etc. There, it's still work in progress. And you see mobility indicators are significantly below the indicators for countries that have stopped the virus. And, there's a lot of concern that the longer this draws out, the more even companies in healthy sectors are going to be seriously affected. So the playbook has shifted from save the economy for a couple of months to we got to take a look at the medium term and how do we deal with that?
Yeah, understood. And I guess one of the challenges is that unlike so-called sort of normal recession or even a financial crisis, you don't necessarily want to stimulate demand in the same way because it could lead to a breakout in the virus. So it's not simply giving incentives for shops to open. So it's kind of a bit more of a struggle of what are you trying to control for? What is policy trying to do here? Is it to stimulate demand? It's not clear whether that's the case. And if it's not, if it's there to just provide some kind of life support for businesses and then some kind of welfare support to the public population, how sustainable is that? Can the state really be able to provide that?
Absolutely. So I think it's useful to separate the various phases of dealing with the pandemic into one is directly fighting it. The second is relief measures for households and small businesses that have difficulty. As you said, relief can last only so long at full relief levels, after which it has to go down to a sustainable level. You cannot have people being paid much higher than normal unemployment levels for the indefinite future, effectively a universal basic income over that period. So that's relief. And then there's repair. When you finish dealing with the virus, there are a lot of broken firms that have excessive leverage, firms that need to fix their capital structure before they can get back on track, before they can get working capital to borrow and invest. So repair and restructuring is phase 3. And then after that comes the recovery, where less than fully, somewhat targeted stimulus may be useful. For example, construction in many situations, it's open air, doesn't involve such a great risk of infection, but certainly will build up demand for iron, for cement, and so on. And finally, I think there is the question of reforms, whether it's reforms to the real sector, to employment conditions, trying to fix the fault lines that have existed for some time, but are even more highlighted by the pandemic. For example, the left behind regions in a country, how can we get more activity back there? Those are the kinds of questions I think that come up once you're beyond the recovery. Now, for some countries, it's going to be very hard to separate these various steps. And you may have to combine a few, you may have to take them out of turn. But these would be, to my mind, the 5 stages of dealing with the crisis.
We talked about sustainability, and one of the big topics in markets, at least, is this whole idea of QE, MMT, infinite ability of sovereigns to be able to borrow. Now, developed countries, you could argue, maybe have a certain amount of historical capital they built up to be able to do that and credibility, but you're also starting to see many emerging market countries starting to experiment in that, whether it's Indonesia or indeed other countries. Where do you kind of stand on all of these concerns about the incredibly high levels of debt we're seeing, government debt, say, but then at the same time, markets prices of debt the yields at least are very low. And if you look at, say, emerging market spreads, credit spreads are very low. So the markets are kind of telling you that they aren't worried. Yet we know debt levels are high, and there's more talk of QE, even for emerging markets, MMT. How do you square these circles?
We do know from past experience that markets can remain fairly complacent until a certain point, and then they turn on a dime and can't sell anything into the markets for love of money, or indeed money. The reality is that we are, at this point, in a benign phase supported by enormous amounts of central bank liquidity emanating from the primary reserve currencies, the euro area, the US Fed, and to some extent the Bank of Japan and the Bank of England. But we must also recognize that there are no free lunches. If there's one statement you keep wanting to pound into the heads of every policymaker, there are no free lunches. If you borrow today, there is a presumption that it will be repaid at some point. And so you are, in a sense, taking away resources from somebody else in the future, not just the ability to borrow, but forcing them to repay. Now, it may be a generation or two down the line. It may be your children who are going to repay this, but somebody at least will have to be on the hook to repay. Whether they repay or not, whether they can pass it on further to their children is certainly a question. But you are taking away borrowing capacity by borrowing today. So the idea that there are free lunches, which certainly is what the layperson takes away from MMT, the modern monetary theory, it's very sort of attractive, seductive, but it's absolute nonsense. So if that's the message that is sought to be communicated, it is wrong. If the message is there are times when the ability to spend is opened up a little more. And, if you spend judiciously at that time, you may be making an appropriate trade-off, preserving the integrity, the health of the economy over a panic period. And that will be good for the economy going forward. And you're sort of evaluating this trade-off well. I think that's a reasonable thing to do. And if that's the message that is coming from MMT, look, you have a little bit of more leeway now, I'm fine with that. There are periods when you have more leeway. The message can't be, don't worry, be happy. It has to be, yes, take advantage of periods when you have a little more spending capacity, but use it wisely, because there's no such thing as a free lunch. You will have to repay at some point. That's what any sensible economic theory tells you. And I think that's what we understand now. So when the banks aren't lending, when inflation is low, it is quite possible for the central bank to expand its balance sheet somewhat and finance more activities that the government wants to undertake. That doesn't mean that's free debt. It's equivalent to debt issued by the government. Think of the central bank issuing debt as the same as the government issuing debt. It's the consolidated balance sheet you're looking at. Somebody is responsible for repayment. It's either the central bank or the government. And, at low interest rates, it really doesn't matter who it is. As inflation picks up, it does matter a little more who it is, because the central bank often is financing itself with effectively forced loans from the banking sector. And there's a limit to how much the banking sector is willing to do that, especially as economic activity picks up. So my sense is, yes, there is some room now, but it doesn't mean the debt level doesn't matter. It doesn't mean that we should just keep spending without thought of who's going to repay. And I think there are big philosophical issues that are raised. How much are you going to bail out companies? Shouldn't the capital holders of the companies take a hit? Why should Joe Schmo, who's a small guy paying taxes, he sort of has enough income to pay taxes, why should his taxes go to bail out a capital owner? After all, neither of them saw the pandemic coming. Neither of them is responsible for the pandemic. So why should one go to bail out the property rights of another? I mean, it strikes me these guys who want to open up the government wallet and spend to protect everybody from the consequences of the pandemic don't realize there's one person bearing the hit. It's that person who's going to pay the taxes down the line to repay the government debt. May not be you, but certainly are your children. And the question is, why do they have to pay when they have no part in this?
Yeah, absolutely. And I guess on the subject of free lunches, one typical way debt problems become a problem is inflation. You end up having the inflation tax. So that ends up being the punishment, so to speak. And many people have called or were expecting high inflation after 2008, after all the so-called printing of money and so on. We haven't seen it. Inflation's been fairly benign. Do you think this time's a bit different now that we have more of the conditions for more of an inflation environment over the next 5-10 years or 2-3 years even?
Well, as you pile up more debt, you reach the point where markets start asking, are you going to generate the surpluses down the line to repay the debt? Do we have confidence that the debt will get repaid? If you look at every emerging market crisis, it happens when the markets say, no, they simply don't have the political functionality to raise the taxes to repay it. So now that I know that they can't, I'm going to put a sudden stop on them. I'm not going to finance any more debt of theirs, which means that even the existing debt becomes a burden for the country. So that point where the markets start believing you have no ability to service your debt going forward is going to be reached somewhere for industrial countries. You could argue, we thought, Professors Reinhardt and Rogoff have done work on this. They used to argue it was 90% of GDP. I think Ken today would say, no, I think it's much more because interest rates have come down. But there has to be a number. Let's say it's 150%. Let's say it's 170%. There is a number there. And that indicates the point at which once the markets do believe that you have no ability to finance, there are two possibilities. One is that they don't really think the nominal debt you've issued is worth what it is. And one way they have of reducing its value is by having higher inflation. So that's what economists call the fiscal theory of the price level. When you have so much debt outstanding, the debt itself and your ability to repay it determines inflation levels. And as you try and borrow more, inflation picks up even more, and eventually you have the hyperinflation. So we're very far from that right now, but it's not saying that it's never a possibility as you keep increasing borrowing. The other, of course, is an outright default. Now, countries that print their own currency don't need to go to an outright default. So they can always repay their debt with their own currency. So it seems more likely that they will have inflation. That said, there are countries that have defaulted on their debt even when the debt is denominated in their own currency.
And what do you make of the Japan paradox here? You know, Japan has very high debt levels and they've had incredibly low inflation and they've been able to maintain this high government debt load for a long, long time. People often like to sort of leave Japan as an exception, but sometimes the exception proves a rule or perhaps not. I mean, do you have a view on the Japan case?
Of course, lots of things we don't understand about Japan. It's been aging along this time. There's a lot of investment within Japan, which is financed by the Japanese people. They feel a sense of trust, a sense of comfort that, in fact, they will not be defaulted on. And that could indicate that you have some more leeway in debt. And yes, Japan is certainly the outlier, but there are outliers on the other side, right? Countries that have reached 40-50% of GDP. Take Argentina, which defaults frequently at those levels of debt to GDP. So, I mean, how much can a country push? How much debt can it accumulate before the debt becomes hard to support? Italy right now at 140% of GDP, industrialized country, but effectively being supported by the ECB. Otherwise, spreads would blow out. That's an example where, you pretty much have reached the limit of how much you can borrow.
Some of the work I've done in this area finds that the country runs a current account surplus like Japan. That means the country has excess savings, so that does make a difference. So if you run a current account deficit, that's more of a challenge. I guess one question, I suppose, where you talked about how you can have sudden stops of capital flows, that kind of begs the question of the architecture of the international financial system. So there's been this sort of school of thought that you should liberalize markets, have flexible currencies, open capital accounts, and so on. Do you think that's still a wise proposal, or do you think that needs modification, especially for emerging markets?
What I've always believed is shock therapy in opening.
Yeah, the shock therapy, yeah.
Yes, I understand Poland is one of the success stories today, at least economically speaking, and may have benefited from that. Leszek Balcerowicz will always tell you that. But I think maybe they were successful because they also could build on some institutions they had. But I do think that a measured pace of opening, where the institutions are constantly being tested and get stronger over time as you open more, it's sort of chicken and egg. You need the institutions to be tested, but not too strongly. So you want measured opening and keep checking that the institutions have grown to deal with more of the volatility that they have to experience, and then open a little more. That certainly was the Indian approach. And I could argue that perhaps we should have opened faster throughout. But I think the direction is broadly right. And if you open up steadily but surely and never go back, that would be ideal. And then you can determine what pace you go at depending on your comfort levels. I would support that. I wouldn't support closing yourself off permanently or halting the process of opening at some level and saying this is the optimal opening. I would see it as a process where you continuously open more, but do it at a pace that you feel comfortable with.
And in terms of, say, the US dollar as the sort of anchor reserve currency of the world, there's kind of more, perhaps there's some unease around the dominance of the dollar. Obviously, the share of the US economy in the world economy is going down, yet in financial market terms, the dollar still has dominance there. China seems to be asserting itself a bit more in the international financial system, trying to open up the renminbi. Europe doesn't quite have a position, it seems, on whether it should promote the euro or not. Do you think it's important what the reserve currency is in the system, or is that kind of more of a tertiary issue that we shouldn't focus on so much?
I think it is an important issue, but I think the notion that it's easy to displace the reserve currency, the primary reserve currency in the United States, I think people sort of underestimate what is needed. Clearly, more than just having a big economy, you certainly need deep financial markets. You need a lot of liquidity in those financial markets, the ability to go in and out, the ability to do that without asking too many permissions, and confidence that financial markets will not be used as a weapon against you so that you can let your money stay. I think the United States historically provided much of this. The trend in recent years to use financial weapons, to weaponize the financial system, is something that has a number of countries worried. Certainly Europe, for example, wants to find an alternative to SWIFT. And you can see that some countries are now reluctant to hold as much of their reserves in US dollars as they used to because they fear it may be weaponized against them. So there are attempts to find alternatives. The expansion of the SDR was an example of this. But really, you don't see the financial markets of either the euro area or the renminbi area being deep enough to displace the United States as of now. Now, doesn't mean that it won't happen over time, but it needs a lot of work. And it needs a lot of confidence in the political structure of the country. I think despite some setbacks in the United States in recent years, I think people still have tremendous confidence that the United States political structure will get it right. There is a judicial system which can contain the excesses of the executive. And so that will give them more confidence to hold dollars than anything else.
Speaking of China, question on the economics of China. Many emerging markets have struggled to escape the middle income trap. We've had a few, Korea, Taiwan, some of these countries, some of the smaller ones like Singapore. But for a super large country like China, it could prove to be very difficult. Now, of course, the size of the economy is very large, but the GDP per capita still isn't at industrialized Western country levels. Do you think it's possible for a country like China to escape the middle income trap?
China has done exceedingly well in getting to middle income. And what I write in my book, Third Pillar, is that in a sense, it had the right structure for that, not to take anything away from the governance over this period, but getting to middle income means, to put it simplistically, build the infrastructure, build the roads, build the highways, create the jobs, many of them in construction, that take people away from agriculture into something more value added. And that China has done very well, of course, with the infrastructure that has made it possible to generate an enormous amount of manufacturing activity. It has become the workshop for the world. So it built upon what was already there, which was a very strong schooling system. Universities weren't fantastic, but the schooling system was good, even during the communist era. And of course, up to a certain point, even the healthcare system was good. So people's capabilities were quite reasonable, and that was part of the reason for growth. Now, from middle income to advanced, you're at the frontier, and there it becomes a little harder. Now, maybe that the Chinese people will still continue innovating, thinking, etc., with a somewhat more authoritarian regime sort of governing them. I think the Chinese game plan was to become a little more democratic over time. Seems to have halted under the current administration. Now, can you grow? My concern in the book was that the problem is markets will do some crazy things. And if you are the primary authority in the country and there are no constraints on you, you can intervene whenever you want. The temptation will be to intervene primarily because people, knowing you have the power, will hold you responsible. And so you basically become responsible for all the problems the markets create. And when you become responsible for all the problems the markets create, think of it as a gigantic Communist Party put, like the Fed put. And when you have that kind of put, markets don't work well. So my sense is, unless you can break the link between the government and the markets, and let the markets run independently, and that's not going to be possible. I think democracy helps there because you can always blame it on the previous guys. They're the guys who did it. And I'm blameless, right? I think we see the current administration in the US taking responsibility for all the good stuff that happened, and all the bad stuff is the previous guy, even now. And I think that's useful to have. You need a scapegoat. But if you were the previous guy also, you have no ability to blame the previous guy. You have to own all the policies of the Communist Party right since 1949. And that makes it very hard to disclaim responsibility. And so Janos Kornai talked about the soft budget constraint. And I think that's the problem, that in these authoritarian regimes, without a strong change in regime every so often, you basically don't have any escape. You're responsible for everything. And so that's my worry, that they won't be able to leave alone the big private enterprises. They will have to intervene when the market ups and downs. There will even be periods when they will talk up the market. And then find when the market goes berserk that now people hold them responsible. You're the guys who talked it up. We went and bought shares. Now you better stop the shares from falling.
And in your book, Third Pillar, you also contrasted China with India. I mean, this is kind of the classic comparison people make. You know, your point there, I guess, was that it's less centralized, India, compared to China. And I suppose also there's a difference in the schooling system and manufacturing service sector sort of balance. What's your sort of prognosis there?
Well, my worry is over the last few years, India is taking the wrong lessons. Instead of focusing on strengthening its capabilities on the schooling, we're doing something on healthcare, but really schooling, infrastructure, etc. And while preserving the strengths of a more decentralized democratic system, we are becoming more centralized, more authoritarian, less willing to entertain different opinions. That is a trend. I think it can be reversed. I think India has strong democratic instincts, but I do worry about this trend, which will make it harder for India to progress. If the government cannot be challenged, cannot be questioned on what it does, and we combine that with the fact that India is not particularly effective or efficient at a number of things, the inefficiency gets entrenched. What is good about democracy is it raises questions. And so you have the ability to change path, and especially if the questions are asked in a timely fashion and they're not killed. I mean, the questions aren't killed. But if, on the other hand, people don't have the right or the incentive to ask questions, and you don't have a particularly efficient form of government, you can go way off track. And my fear is if India continues to become more authoritarian and centralized, that's exactly what will happen.
I guess the shift towards more centralization, I mean, that's not just an India phenomena, that's a global phenomena. We're seeing that around the world. So we kind of know that part of that is in response to the downsides of globalization and how it's hurt the working class. Part of that is also, I guess, automation technology. How can you somehow reclaim the values of liberal democracy while at the same time understanding the negative sides of globalization? You talked a lot about this in Third Pillar, actually. I guess also touches on the inequality issue as well.
Well, I sort of place many of our problems today, I ascribe them to technological change, which in part has facilitated globalization, right? And what I argue in some ways is that the expansion of markets made possible by new technologies, for example, cheaper transportation, cheaper communication, has made possible, production across the world and trade across the world. That's been a good thing, but it also has created a push for more centralized governance. That is, countries themselves need common rules within the country. You can't let each region set its own rules. You take away the powers from the regions into the national capital simply because you want a level playing field within the country. And then in regions like the Euro area, it doesn't stay with the national capital, it goes to Brussels. And so there's a tremendous amount of centralization in the name of the markets so that the markets can have a level playing field. And you see that increasingly in international trade agreements. The TPP, for example, has a lot of intrusive stuff on what each country must do in each area so that companies can freely range across the world, including the fact that countries give up the right to have judicial systems enforce their laws on companies. Everything has to go up to arbitration. I mean, we have at this point globalization coming at the expense of sovereignty and democracy. And because many of these deals are done in back rooms far away by the elite of a country, including their corporate elite, and sometimes thrust down the throats of other countries that don't have either the insights, the analytical capability, or just the power to stand up. Take, for example, the Global Agreement on Intellectual Property, TRIPS. Many argue that the details of TRIPS were, in fact, driven by a few pharmaceutical companies. Whatever the truth be, why should every country sign up to a common set of agreements on intellectual property when, in fact, the optimal level of intellectual property protection differs from country to country? Countries that don't have much intellectual property production of their own might, in fact, benefit from not protecting it too much initially until they start producing more. In fact, that might well be the optimal thing to do. It's what the Western countries did when they were developing. So for everybody to have a regime which is as strong as the strongest country doesn't make sense. And this is what people are rebelling against in Britain when they say take back control. They want to take back control first from Brussels to London, but even from London to their local authority, because they simply feel they have no rights, no ability to determine their future. That, to my mind, is what we need to focus on. How do we have the globalization we need? I am a firm believer in free trade, largely free trade and largely free cross-border investment. How do we get that without accompanying it with a whole set of rules that emanate from elsewhere and constrain what I can do as a person, which limit my democratic ability to choose? So can we get the benefits of trade without having rules come in through the back door? That's really my question in the book. And I argue it is possible, but we have to pay much more attention to the fact that we are actually inflicting a whole set of new rules and requirements on people when we ask them to sign up to trade.
That's all very interesting. And in terms of your research agenda, what's your big focus at the moment?
It's a great question. Partly, I'm trying to understand all the monetary stuff we're doing nowadays. As you said, QE was started by the industrial country central banks, and now a lot of emerging market banks have taken that up. What are the consequences of expanding your balance sheet significantly? What could go wrong? I'm fascinated by ideas of liquidity, whether in fact we've gotten ourselves into a period of repeated crises. Every time we become more accommodative to deal with the previous crisis and create the roots of the next crisis. The usual rolling crisis argument, but trying to understand it more in depth and doing some empirical work on it. So that's one side. I'm doing some work on sovereign debt and what limits it. Can even odious governments be disciplined by sovereign debt? Does it make sense to declare them odious and say you cannot borrow? Or could it be that it can actually help constrain their worst instincts as they try and do the right things so as to preserve their borrowing capacity? So is our markets a good thing or a bad thing for those governments? I've gotten engaged in research in a fairly serious way. Some of my research is looking at the historical evolution. For example, one of my papers is on the historical evolution of secured debt. There used to be much more of it in the US. In the early 20th century, it's come down significantly. The big question is, why do people not feel the need to demand security anymore? Is that a part of financial development? Of course, in financial markets, we want everything secured, right? Repo arrangements are all about security. So why is it so different for industrial firms versus financial firms? That's part of the question we're asking. So basically back to research, but also looking at the world and worrying about where we're going.
And actually on that, about the world, I mean, there's a lot of pessimism around institutions and populism and so on. Are you optimistic about the future, the next 5-10 years?
I'm optimistic, but I don't want to sound naive. Every force that we see is pushing us in a darker direction. We talked about authoritarianism. We haven't talked about populism, but that also seems to be a reaction to inequality, to left behind people, to people who seem to have lost position. So there are a variety of forces, all of which are hitting against the global order. Now, I think change may be good. The old order was unsustainable. The levels of inequality simply didn't work. Young people didn't have the opportunities that they absolutely needed. And so we need to make changes. Some of my colleagues talk now about more equality in incomes, making it more sustainable. I certainly talked a little bit about that in my previous book. And maybe that's the way we need to go. But we need to do it in a way that doesn't jettison everything that works. We can't suddenly assume that because markets have had their difficulties, that we go back to governments. We've tried that experiment. It didn't work. It ended in the 70s simply because it didn't work, not because of Milton Friedman or neoliberalism. So let's move forward rather than go back in a circle to try what didn't work and see if we can get fresh solutions. And that's really where I think the answers will lie. And I hope we will get the silver lining from this kind of pandemic. We will re-examine our assumptions, but instead of jettisoning everything, we will reformulate it to a better world. Now, that may sound naive because the likelihood is we will end up worse if we don't pay attention. I have faith. I have faith in humanity to say, well, we have to work on it and we will try and get it right. So it may take time, but I'm hopeful.
Well, it's nice to end on that note. So thank you very much, Raghu. Excellent conversation. Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a rating and let other people know about the show. Also, sign up to become a subscriber to our research at macrohive.com. We'll be back soon, so tune in then.